listen to me and listen carefully, because I am not going to repeat myself and I am not going to waste your time with pleasantries. I have spent over 5 decades on Wall Street building, breaking, and rebuilding companies that other people were too slow and too soft to fix. I have taken on boards, boardrooms, CEOs, and entire industries, and I have made billions doing it because I see what is coming before the crowd does, and I move without hesitation. Right now, I am looking at the American financial system, and I am seeing something that I have not seen in a very, very long time. I am seeing the specific combination of conditions, debt, inflation, political dysfunction, and market complacency that precedes a catastrophic wealth destruction event. A crash, a real one, not a correction, not a dip, a crash. And the window to protect yourself from it is closing faster than most people realize. The year 2026 is not a guess. It is a mathematical inevitability written in numbers that are hiding in plain sight. If you are not subscribed to this channel right now, you are making a financial mistake. The analysis I am delivering in this video alone is worth thousands of dollars in advisory fees that Wall Street firms charge their private clients. I am giving it to you for free, in plain language, with no agenda other than making sure you do not walk blindly into the worst financial event of your retirement years. Hit that subscribe button right now before we go any further. Do not wait until the end. Do it now. Let me tell you something about how real investors think about risk, because it is fundamentally different from how your financial advisor, your brother-in-law, and every cheerful television personality thinks about it. Real investors do not look at market sentiment. They do not look at what feels right or what the consensus says. They look at numbers, cold, hard, undeniable numbers. And the numbers that are sitting in front of us right now are not ambiguous. They are screaming at anyone with the intellectual honesty to read them without blinking. The United States government is currently carrying a national debt that has exceeded $35 trillion. That is not a political talking point. That is a balance sheet. And when I look at a balance sheet, I ask one question. Can this entity service its obligations without destroying itself in the process? The answer, when you stare at America's fiscal situation honestly, is no. Not without consequences that will be severe, and not without those consequences arriving sooner than the political class wants to admit. The interest payment on that $35 trillion in debt has now crossed $1 trillion per year. $1 trillion every year, just in interest, not paying down the principal, not investing in infrastructure or defense or anything productive, just servicing the cost of borrowing money that was spent in the past. That single number, $1 trillion in annual interest payments, tells you everything you need to know about the structural trap this country is in. And it gets worse when you factor in the mechanism that created the situation in the first place. After the 2008 financial crisis, the Federal Reserve took interest rates to essentially zero and held them there for over a decade. They pumped trillions of dollars into the financial system through a process called quantitative easing. The effect of all that cheap money was entirely predictable. It inflated the price of every asset class. Simultaneously, stocks, bonds, real estate, private equity, everything went up. Not because the underlying value of those assets increased, but because money was free and had nowhere else to go. That era ended in 2022 when the Federal Reserve was finally forced to raise rates aggressively to fight the inflation that all that money printing inevitably caused. Now we are operating in a world with interest rates dramatically higher than anything we saw in the decade before, while simultaneously carrying the debt load that was accumulated when rates were at zero. That is a structural mismatch that does not resolve itself quietly. Layer on top of that the tariff regime that is now in full effect, the most aggressive trade intervention this country has seen since the 1930s. And you have added an inflationary accelerant to an economy that was already struggling to absorb higher borrowing costs. Tariffs raise the price of imported goods. That is not a theory. That is economics. And the full effect of those tariff increases takes 6 to 18 months to fully work through supply chains and show up in consumer prices and corporate earnings. We are inside that window right now. The commercial real estate sector is quietly deteriorating under the weight of refinancing obligations at interest rates that are 2, 3, sometimes 4 times higher than the rates at which the original loans were written. Regional banks are sitting on those losses. The stock market is still priced in many segments as though the era of free money is returning. It is not returning. And when the market finally prices in that reality fully, The adjustment will not be gentle. Now let me tell you what really makes me angry, because anger is the appropriate response when I see what is happening to ordinary Americans who did everything right for 30 years and are now sitting in portfolios that are quietly loading up with risk they do not understand and have not been warned about. The financial planning industry in this country has been selling a 40-year-old playbook in a world that changed fundamentally in 2022. The classic advice, put your money in a diversified mix of stocks and bonds, rebalance annually, trust the long-term trend, was reasonable advice when interest rates were declining and inflation was contained. It is dangerous advice right now. And the people giving it either know that and are not telling you, or they do not know it and that is worse. Here is the specific danger hiding inside what most people believe is a safe: portfolio bonds. The word alone has become synonymous with safety in the minds of most retirement investors. For 40 years, from 1982 to approximately 2020, that association was more or less accurate. Interest rates were generally falling during that entire period, and when rates fall, bond prices rise. A retiree holding long-term government bonds during those decades was actually sitting in an asset that went up in value while also paying interest. But that is not how bonds work when inflation is rising. When inflation is rising, interest rates go up. And when interest rates go up, existing bond prices go down. A 30-year Treasury bond loses approximately 18% of its price value for every single percentage point rise in interest rates. Think about what that means in concrete terms. If you are holding $200,000 in long-term government bonds, right now when interest rates rise by 2 percentage points, which is entirely within the range of what is possible in the environment we are discussing, you have just watched $72,000 evaporate from what you were told was the safe part of your portfolio. That is not a theory. That is arithmetic. And it is happening to real people in real retirement accounts right now, silently, while they sleep. Beyond the bond problem, the equity side of most retirement portfolios is loaded with technology stocks carrying valuations that were justified in a world of zero interest rates, and they have not fully adjusted to the new reality. High-growth technology companies with enormous price-to-earnings ratios are the most sensitive assets in existence to changes in interest rates and inflation expectations, because their entire value is predicated on future earnings discounted back to the present. When the discount rate goes up, which is exactly what happens in an inflationary environment, those future earnings are worth dramatically less today. Getting out of overvalued growth stocks before the broad market finishes pricing, and this reality is one of the most important financial decisions a person in or approaching retirement can make in this moment. The time to move is not after the crash has started. At that point, you are selling at the bottom and locking in permanent losses that could take you a decade to recover. And here is the brutal truth about retirement that nobody says loudly enough. When you are young and the market drops 40%, you wait, you keep contributing, and 10 years later you are fine. When you are retired and drawing on your savings, a 40% drop is not a temporary problem. You are selling depressed assets to fund your living expenses. You are crystallizing losses at exactly the worst moment. You may not live long enough to see the recovery. That asymmetry is the single most important financial concept for anyone in or near retirement to understand right now. The first place I want you to consider moving your money is gold. And I want you to hear me out before you dismiss this as a gold commercial, because the framework I'm about to give you is different from anything you will hear from the people trying to sell you coins on late night television. I do not think about gold primarily as an inflation hedge, although that is part of it. I think about gold as a hedge against the specific kind of fiscal catastrophe that I just described to you, which is government overspending funded by money creation that progressively destroys the purchasing power of the currency itself. That is called currency debasement. And it is different from ordinary inflation in an important way. Ordinary inflation is a general rise in prices caused by too much money chasing too few goods. Currency debasement is a structural loss of value in the currency itself caused by a government that cannot stop borrowing and printing to cover obligations it cannot meet through taxation alone. When a government is running structural deficits of the size we are currently seeing, deficits that cannot realistically be closed through either spending cuts or tax increases. Given the political environment, the only remaining tool is inflation. Inflate the debt away, gradually erode the real value of the outstanding obligations by creating enough money that a fixed dollar amount of debt represents a smaller and smaller share of a nominally growing economy. That process is devastating for people holding cash savings and long-term fixed income investments. It is very, very good for people holding gold. Gold is priced in dollars. When the dollar loses purchasing power, you need more dollars to buy the same ounce of gold. That is not gold going up in value in any absolute sense. That is the dollar going down in value. But the effect on your portfolio is the same. Your gold position grows in dollar terms and protects your purchasing power, while the people holding cash and long-term bonds are quietly getting robbed. Look at what gold has done over the past 3 years while interest rates were rising and bonds were losing value. Gold quietly and steadily moved to multiple new all-time highs. Central banks around the world, China, India, Russia, and dozens of emerging market economies have been buying gold at the fastest pace in decades. They are not doing that because they love shiny metal. They are doing it because they see exactly what I see: the long-term structural decline of the dollar as the world's unquestioned reserve currency, and they are repositioning accordingly. For most people watching this, the practical implementation of a gold position is through an ETF, specifically GLD or IAU, the two largest and most liquid gold ETFs available. They can be held in a standard brokerage account, in an IRA, and they track the price of gold with very low management fees. If you have a higher risk tolerance and you want more leverage to gold price movements, the large gold mining companies like Newmont and Barrick amplify the movements in gold because their profit margins expand dramatically when gold prices rise, while their operating costs stay relatively fixed. The appropriate allocation is not everything and not nothing. A meaningful position somewhere in the range of 10 to 20% of a portfolio provides genuine protection in the scenario I am describing without creating an irresponsible concentration in a single asset class. Gold is the insurance policy that pays out most generously. In exactly the environment we are walking into, own it. Now I need to talk to you about bonds in a way that is going to contradict what your financial advisor has been telling you. And I need you to have the intellectual courage to follow the argument carefully rather than dismissing it because it conflicts with what you believe. Bonds are not safe. Let me say that again with complete clarity. Bonds are not safe in an inflationary environment. And anyone telling you that, moving more of your retirement into bonds as you age is automatically the conservative, safe choice, does not understand the interest rate risk embedded in long-duration fixed income securities. I already gave you the math. An 18% price loss for every 1 percentage point rise in rates on a 30-year treasury. But let me frame it differently so it lands with full force. The people who moved heavily into long-term government bonds in 2020, following standard retirement planning, advice about shifting toward fixed income as they approach retirement, watch 20, 30, even 40% of the value of those positions disappear between 2020 and 2023 as interest rates rose from near zero to over 5%. That happened. It was not a stock market crash that made headlines. It was a slow, grinding, catastrophic loss in the part of the portfolio that people were told was protecting them. So what do you do with the bond allocation in your portfolio? The answer has two parts, and both of them come directly from the framework of sophisticated macro investors who have navigated inflationary environments before. First, if you are going to hold any bonds, hold short duration bonds, specifically treasury bills with maturities of 3 months, 6 months, or 1 year. Short duration bonds have minimal sensitivity to interest rate changes because they mature so quickly. If rates go up, your treasury bill matures in 90 days and you reinvest at the new higher rate, you do not suffer the price destruction that long duration bondholders experience. Right now, short-term treasury bills are yielding in the range of 4 to 5%. That is a genuine risk-free return that was not available for most of the last decade. It is not glamorous, and it is not going to make you rich, but it will protect your capital and generate a reasonable return. While you wait for clarity on where the broader market is going, the second option within the fixed income space is Treasury inflation-protected securities, known as TIPS. These are government bonds where the principal value adjusts upward automatically with inflation. If inflation runs at 4%, the face value of your TIPS investment grows by 4%, and you earn interest on that larger principal. In an environment where tariffs are pushing consumer prices higher and inflation is reaccelerating, TIPS are one of the very few bond instruments that actually does the job bonds are supposed to do. which is protect your purchasing power in real terms. The critical discipline here is the distinction between short duration and long duration instruments. Short duration treasury bills and tips of your friends in the current environment. Long duration nominal bonds, meaning traditional 30-year treasuries, and long-term corporate bonds with fixed interest. Payments are one of the most dangerous instruments you can hold when inflation is rising. If your portfolio is currently heavy in long-term bond funds because a financial advisor told you that was the safe conservative choice for a person of your age, you need to have a frank conversation about repositioning. Not because you are taking on more risk, precisely because you are taking on less risk by moving out of assets that are dangerously exposed to the interest rate environment we are in. The third position is where the real opportunity lives. And this is where I want you to think like an investor rather than a saver. The first two safe havens I described to you are primarily defensive. Gold protects against currency debasement. Short duration bonds and tips protect against interest rate risk and inflation erosion. They preserve wealth. What I'm about to describe to you actually grows wealth, even in a difficult macroeconomic environment. And it does so through a concept that is deceptively simple, but extraordinarily powerful: pricing power. Pricing power is the ability of a company to raise its prices without losing its customers. That sounds obvious, but think about what it means when inflation is running hot and costs are rising across the entire economy. A company with genuine structural pricing power can pass those cost increases on to its customers, maintain its profit margins, sustain its earnings, and hold its stock price even as the broader market struggles. A company without pricing power gets squeezed from both sides. Costs go up because of inflation, and it cannot raise prices without losing customers to competitors. So margins compress, earnings fall, and the stock follows earnings down. The sectors where pricing power is most structural, most durable, and most relevant to the current environment are three: healthcare, energy, and consumer staples. Healthcare is the most important one. The demographic reality of the United States over the next 20 years creates a captive, growing market for healthcare services, regardless of what happens to interest rates, tariffs, or the broader economy. The baby boomer generation is fully in its retirement years. The demand for prescription medications, medical procedures, hospital services, medical devices, and elder care is going to grow for the next 2 decades, driven purely by demographics. That demand is not discretionary. You do not decide to skip your cancer treatment because the market is down. You do not defer your hip replacement because inflation is running at 6%. Healthcare companies with dominant positions in essential treatments have the pricing power that is practically permanent, backed by the inelastic demand of an aging population. That is why healthcare stocks have consistently been among the best performers during both recessionary and inflationary periods throughout market history. Energy is the second sector with structural pricing power in this specific environment. Tariffs disrupt global supply chains and create uncertainty about the international movement of oil and gas. Supply chain disruption historically pushes energy prices higher. American domestic energy producers, companies that pull oil and natural gas out of the ground here in the United States, benefit directly from higher energy prices. Their revenue rises with the commodity price while their operating costs are relatively fixed. When oil moves from $80 a barrel to $100 a barrel, the margin expansion for a well-run domestic producer is dramatic. Those earnings flow directly to shareholders in the form of growing dividends and share buybacks. In that world, the promise of enormous earnings 15 years from now is worth a great deal today. In a world of 4 to 5% interest rates and persistent inflation, those future earnings are discounted much more aggressively, and they are worth dramatically less today. The adjustment in valuations for the most overpriced growth stocks has started, but it is not finished. And the investors who wait for the crowd to fully recognize this reality before selling will be selling at the bottom alongside everyone else. The practical implementation of this strategy is not complicated. Look at the holdings in your retirement account. If you are heavily concentrated in broad technology-focused index funds or in individual growth stocks with price-to-earnings ratios that are multiples of the market average, rebalance toward healthcare ETFs, energy sector funds, and consumer staples ETFs. These instruments have lower valuations, real current earnings, genuine pricing power, and real dividend yields. They are not going to triple in a year. They are going to hold their value pay you income, and outperform dramatically relative to the rest of the market when the broader correction fully arrives. Comment below and tell me which of these 3 positions you are already in and which one you are moving into today, and then go make the calls. Do not wait for next week. Do not wait for confirmation. The window is open right now, and it will not stay open forever.